All right. So if you can't see the slides now, interrupt me. So this is meant to be kind of a venture capital 101. It's not a pitch deck session. It's not how to build the right team and go about networking and hiring. It has some of that, but it's really meant to be a focus in on what venture is, almost like what motivates a venture capital fund, how we think about building a fund, and what are our incentives, as well as topics related to how you can think about what accepting dollars from a venture firm might mean in terms of the equity you're giving up, and ways for you as a company to raise your first investment of any sort, whether it's non-dilutive or dilutive. And then a little bit on how you can think about, building your how you should think about building your first kind of co-founder split. So it's a grab bag of ideas that we've found valuable for various conversations with university efforts, and we'll just go through some of them today. So with that, I'll just give you a quick primer on our fund, Osage University Partners, OUP, so that you just get a little background as to where I'm coming from. We're a really unique venture firm in that we exclusively invest in startups that spin out of university research. So that typically means a couple things. One is, down the fairway is you're a researcher, you have a patent at the university, or there's a patent at the university that you want to license into your startup, and you're in our mind a spin out when that happens. And the other area is just university graduate students and faculty and postdocs, researchers that are starting companies from the university. And there's a little nuances as to why we have those two different definitions, but it's not worth going into here. But we invest across that broad space, and we've been doing that since 2009. And the reason why is reason why we built the fund this way is that universities are engines of innovation. As you know, some very large companies have been built out of university research. Google, Databricks, Illumina, several therapeutics companies. MIT has had several of them. And it's an exciting space to be operating because there's around $100 billion that go into the university ecosystem every year. And generally, that produces around 1,000 startups a year. And the world's known that for a while. We just built a fund that works really closely with the universities themselves because part of venture is about learning how you find out about startups, and then also how do you invest in the ones that you want to invest in. And so we've built really close partnerships with tech transfer offices across the country where we actually share some of our profits from our fund back with the university that we hope continues to drive investment into the university ecosystem and build more startups. And so since we've been doing this in 2009, we've raised around $800 million across 4 funds. So we've been at this for a while. We have our own biases and views that have been shaped, but we've also just learned a lot and learned a lot, mostly from our battle wounds, but obviously from some of our successes in investing now in 130 companies across the space. And when we do invest, it's pretty much across the board of what you would expect in terms of stage and the sectors that spin out of university research. So because the top of our funnel is pretty narrow, our fund's thesis is university spinouts. Some funds might have a medical device thesis or a semiconductor thesis, but ours is university spinouts. And so we're pretty broad. So whenever you're a very specific fund, you tend to go broader in stage. And so we'll invest kind of up to $1 million in seed rounds, Series A, big seed or Series A rounds up to $5 million. And then sometimes we're investing first checks into growth stage companies, where we might write a $5 to $8 million check. And the reason we do think of that is because university spinouts take a while to develop. And so sometimes they look really good at the seed round. Sometimes we don't get that compelled or there's not a good fit and we wait and see. And the product evolves, companies pivot, and they look really good at their Series B round. And so we're pretty agnostic to that. And the sectors we invest in are what you would expect out of university research, where the strengths definitively are in life science, therapeutics, and then in the tech space, physical sciences is much broader. We see success across a variety of sectors. So we've invested in hardware companies in the computing and photonics domain, software companies and AI, obviously, and cybersecurity. And then every so often, we're making materials and climate tech investments as well. So with that, I'll just kind of jump off of the podium that gives you background on OUP. I'm happy to answer questions as they come in. We'll jump into like what is venture and how is a venture firm structured. So it's always good to understand the incentives of who you're working with. And this is, as you think about building a startup that's going to raise venture capital, it's good to have a basic understanding of what's going on at the firms. And so as a venture firm, think of us as a startup ourselves. We receive investment from stakeholders, and these are called our limited partners. Limited partners are anything from nonprofit foundations and endowments, like university endowments, or disease endowments or pension endowments that have very, very large sums of capital, sometimes of billions of dollars that they need to make money on. And venture is in this asset class of private equity, which is considered the high risk, high yield opportunity. And they're looking for diversification in their funds, which range anywhere from bond investments to stock investments to private equity to real estate. So venture is just one aspect of how they invest. And that stretches all the way to limited partners that we meet at corporations who are really interested in technology deal flow usually and science deal flow, as well as family offices. So as you build a venture firm, you have a variety of stakeholders. Most venture firms have 10 to 100 LPs that they're working with to deliver returns on. And so that capital goes into a venture firm that is run by GPs, general partners. And the general partners are usually the decision makers when it comes to an investment. Decisions are a weird thing to describe in a venture firm. They can be very formal at some firms where there's a real vote, but they can also be made in teams where it's basically two or three associates and principals and partners working together to decide whether or not to do a deal. And later I'll go into a few of the personalities you might encounter when you're raising from a venture capital firm. But overall, like our goal is to take the money that our LPs give us and deliver something like a 3x return that will deliver 20 to 30% IRR over 10 years. And the way that we get incentivized is twofold. We extract management fees and carry. So carry is a split of the profits, and most venture firms receive 20% of the profit. And so if it's a $100 million fund and we generate $200 million in return, we get, hand wavy, we get around $20 million amongst the team to be split. And so that is typically seen as one of the most important incentives of a venture firm, because our team, our people, our leaders are only making a lot of money if we make good money-making decisions. And most private equity financial firms are structured in the same mindset. You only really make money when you're successful. However, we still pay the bills. We're all still, have high performance expectations of ourselves, and we want good salaries. And the salaries come from the management fees. And so the management fees are roughly 2 to 2.5% of a fund paid annually for the duration of the fund, with some, tail off as it goes. So they don't last forever. And that is going towards paying salaries, travel, hosting events, anything that we kind of see as important to building the deal flow and deal access that we need. And it's, pretty simple. The one thing I will say that a lot of people don't think about, that I thought about when I was joining venture capital, is this general bogey of being a 2 to 3x fund. Knowing the lifetime of a venture firm is roughly 10 years. Most funds are 10-year funds. I'll comment on that in a second. But if you double someone's money in 10 years, or even triple someone's money in 10 years, that's not actually a good investment. You all are, I'm sure all of you are very smart and can do the quick IRR math on that. But the unique thing about venture capital is we're calling money over time. And so we're not, let's say, getting the first 100 million, the whole 100 million up front. We're getting, 5 million in the first quarter, 2 million in the second quarter, and that kind of spreads out like peanut butter over the life of the fund so that our IRR can be seen as strong. It is stronger than it is. So the people that give us capital don't have to outlay their entire commitment up front. They give some of it and they can make other investments with the remainder as long as they can always call that capital for us when we need it. So the general world of like deep tech investments in venture have had to pressure test this idea of a 10-year life cycle. As you all are thinking about building spinouts out of the university, uh, many of you are developing cutting edge technologies. And so some of it's definitely some startups that I speak with and invest in, it's really early. It could still be in the lab, but there's enough interest for them to spin out. And that usually means that university spinouts do take longer to mature than other startups. And so we've found in our experience in OUP1 and OUP2 that we're really pushing the life cycle of our fund. We have startups that are successful. They're still private. We've invested 2010, 2011. We're still super excited about them, but they haven't been bought. They haven't IPO'd. And so the general venture firm in deep tech is operating with 10 plus 2 years of an extension. But there are funds that are coming to be that have much longer timeframes. So I've spoken to friends who are at 15-year funds, and a lot of these funds are in sectors that we know take a lot of time, like climate tech, and that's a smart way to build things. Ultimately, the best companies take the longest to build, and so our LPs are incentivized to let us stretch that timeline. But the reason why that's important, if you are talking to a venture firm that's non-traditionally doing deep, or is a traditional venture firm, not always doing deep tech, they really do think about the time it'll take for your company to get to an exit with respect to the fund that they have right now. So each fund that a venture capital fund raises starts, and you look to build your portfolio of companies over 4 years or 5 years. And then when you kind of, let's say, have invested or committed $60 million of your total $100 million fund to, let's call it 10 portfolio companies, you wrap up that portfolio because you want to reserve that last 40 million for follow-on investments in those companies out of the same fund. And you time that so that your next fund is ready to be built on, as soon as the kind of portfolio creation happens. And the reason why that's important is that if you talk to a fund that's, let's say, in year 2 or 3 or sometimes 4 of their life cycle, they're unlikely to make an investment in a company that's going to take 10 years to get to fruition, to exit, because that stretches their overall timeline. And so it's totally within bounds as you build your company and talk to venture investors about where they are in their fund life cycle, just to make sure they have the capital and timeline available to be a fit for you. And it's not the first question you might ask, but it's definitely something you are fully privileged to uncover as you're speaking with the investors in your raises. So the main thing that you should be thinking about is we, generally, as we raise fund after fund after fund, we need our companies to grow in value over that time within a fund. And so, when we're raising OUP3, we were being evaluated in OUP1. And the way that we are evaluated is in how the companies either have increased in value or exited. Usually exits are less often, but increases in value are important. And that happens when the company raises their next round and a new set of investors comes in and changes the valuation, increases the valuation of a company from 30 million post money to 100 million. I'll go over some of these terms in a little bit. And so we have metrics and we're crunching very simple spreadsheets on all those numbers to know how we're doing because our LPs are evaluating us and our performance compared to all the other venture firms they know of and making a decision whether to give us their next round of investment for our next fund, which as funds grow can become a very powerful increase in resources. So as we have OUP 1, 2, 3, and 4, we're generating fees off of each of those funds, except for OUP 1, which is just old. And those fees help pay for a bigger team, more programs, and the things that can really build up a venture firm. And you can see some, funds that have been around for decades having massive, massive fleets of investors and marketing teams and HR teams so that they can, build the tools that support the portfolio companies that they invest in. So that's some of the reasons why, building fund after fund is important. And some of the reasons why you'll see a bifurcation really in the funds that have been around for 40 years versus the funds that have been around for 15 years versus the funds that have been around for just 2 years. See if there's a question in the audience. Good question. So one of the questions is, what have you seen to be more valuable to LPs, increases in valuations or exits? It's with our LPs, it's definitively exits. There's two terms that they really look at. One is called total value to paid in capital, TVPI, and the other is DPI, distributed to paid in capital. And distributions happen when you exit a company and you give money back to your LPs. And increases in TVPI come from both exits, but also that next round of fundraising that increases the value, hopefully increases the value of a company in your portfolio. And generally, that they're both important, but in a time like we're in right now, where the venture industry is a little bit on its heels with the abundance of capital that went in during COVID, a lot of LPs don't know what to make of the private valuations that the startups in their venture portfolio, venture firm portfolios have. So companies raising at multi-billion-dollar valuations, not really clear if they're really being, we're just driven by hype or whether they actually have the real commercial progress that you need to have to be worth that is something LPs are starting to question. So you need both in general, but right now DPI is king, is what they say. And so, good question on that.
You also have a second one there, Manny.
Yeah. So is there some kind of centralized resource to look at VCs and where they are in their cycle calls for startups? So within the university, so the arbitrator of not truth, but information is PitchBook. So PitchBook is a fantastic tool to look up funds, startups, corporations, and I believe most universities have access through their libraries on that. And it's like a really valuable tool for not just understanding venture firms, but to understand the competitors in your space, the fundraising trajectory of startups that you might be thinking of as comparables. We use it heavily. It's also really useful for, I found, I'm not a public market investor, but it's also really useful to understand public market companies and their journeys. So, you could go to NVIDIA and PitchBook has great data on their VC journey, which started, I think, in the 90s. And so we're using that. You should use that. To understand venture firms. The one thing I don't necessarily trust in PitchBook are the performance numbers they have on venture firms. So if you wanted to sort of rank and stack and say, I want to work with the best venture firm out there, and you search the database for the best TVPI and DPI, those numbers are not very trustworthy. And I think they try and do some calculations on that. The ones that you can trust from a venture firm performance perspective are the ones that come from LPs who have to release their have to publicly release their private investments. And so there's a few big LPs out there who do that. And so those numbers in PitchBook are valuable, but are helpful, but our numbers, for instance, in the database are not because none of our LPs are forced to release that information, and we don't share it. The other thing that's generally reliable in PitchBook, but we've seen errors in, is just the valuations of startups. I now, like, I've had colleagues who just always doubted it, and over the years they've come to sort of say like, oh wow, how did they know the valuation of the round that I just invested in? Because that's generally also private information. But I think PitchBook is able to get it by doing data calls from the Delaware corporation industry. PitchBook compared to Crunchbase, I haven't used Crunchbase in years. PitchBook has just gotten to be so much better. So before, like when I search for companies, I might, Crunchbase might be one of the top links, and I just find it challenging to use. So my guess is the data is pretty good. But if you can use PitchBook, I would just use PitchBook. It's more searchable. Great. So we talked a little bit about venture firm portfolios and how we kind of think about structuring the timing of investment and the building of a portfolio and reserves. I thought I would pull up this thing that this view that we look at and think about often, which is something everyone probably knows from reading the news. Like venture is about investing in the fund returners, and so a fund returner, kind of by definition, is if you have a $100 million fund and you invest in a company that returns $100 million, like that's a really good success story. And it's hard to do. It is very hard to do. There's a book called Power Law that talks about venture capital and the dynamics there. And the Power Law is about this thing you see on the right, which is most companies fail. So on the x-axis is the multiple on invested capital of, let's say, a fund's investment in a single startup. And there's a typo on the y-axis. This should be percent of startups in the portfolio, by number. So generally 35% of the startups in a portfolio don't return capital. They're in the 0 to 1x. And the 10xers, the 9xers, let's say here, is like 1 or 2%. So this is from a data set that covers 1,000 startups analysis. I think Correlation Ventures did. It's kind of a toy example, but it's always kind of driven in this view of very few of your portfolio companies are going to be big returners. And so the challenge is when you're building a portfolio of, let's say, 10 companies, 1% of them will be 10xers. What does that even mean? You're trying to capture the anomaly of a small n. And so it's really impactful when you do. But the goal of a venture firm is to deliver 3x multiple on invested capital so that we can generate 20 to 30% IRR after fees and carry. If you can do that, fund maybe like one fund or two funds, you've generally set your legacy. But that's really hard to do. And within those frames, most venture firms barely return capital to their LPs. Very rarely venture firms are returning things like 5 or 6 or 7x. The bigger your fund is, people say the harder it is to return these kind of top quartile, top decile type investments. Before I go on, look at this question. Okay. So I thought I'd just give an example. So let's say you have a $100 million fund and you're generally going to invest in 10 companies. There's roughly 10 million per startup. Some funds are built on this, like 10 million into each company. So 4 of them, according to this rough distribution, deliver $0. 2 of them deliver 1x. So you get your money back. So you get 20 million back into your fund. 2 deliver 3x. That's 60 million. 1 delivers 5x. That's 50 million total across that company. So altogether, you've gone through 9 companies and you've only really generated 130 million for your fund. That's okay. It's not it's a fund that's maybe going to be able to raise their next fund. So you have 1 company left. And how big of an outlier do you need here? And it's pretty significant. And so that ends up being 170 million to generate a $300 million fund. It's a 17x type investment. And that happens rarely. And it happens rarely because while certain rounds of a startup can deliver high multiples, seed rounds where the valuation is, 10 or $15 million, the company exits for $1 billion can be very impactful. But you've only been able to put a small amount of money in that round. So we invest in multiple rounds of a company. And so a lot of your money gets, mixture averaged to a higher valuation over time. And so these are the numbers that we as venture firms have to think about when we're building our portfolio. And we're often asking ourselves, like, are there ways for us to game the system? Are there ways for us to be smarter about investing in a portfolio and ways to reduce the risk? And so a couple of the things that we think about are around stratifying the risk by investing in more companies, capturing more of those winners. So if I invest in 30 companies instead of 10, I'm a little bit more likely to capture one of these anomalies of the, let's say, 2 or 3% of companies that generate more than 8x returns. And the other thing we think about is picking our winners better. And so what you should expect as uh, startup entrepreneurs is, so, most venture firms truly believe in their company being successful, but every so often performance wanes. And so what we think about when we're, let's say, deploying $10 million into a company over the lifetime of the company is, let's say I've only put in 2 million into a company at some point, and they're raising their next round. Is this the best use of the dollars of my venture firm in this company, or should I think about another company in our portfolio? And so ways to reduce risk as a venture firm are to, plow money into your winners, the ones you think at that moment have the best chance of success. And so those are two things that we think about in having a larger portfolio than most venture firms to reduce the risk, but also really being judicious and smart about how we put in follow-on capital into our companies. And there's downsides to both scenarios. So one of the things that you think about with a larger portfolio like we have is when you hit a winner, instead of having 10 million into that company, you only have 5. So the winners are not as impactful. So the risk is reduced, but the upside is also a little bit reduced. So I'll pause here. There's a couple of questions that came in. I've heard from several MIT founders and an advisor to avoid VC money if you can get money from any other resource, any other resource. What is your thought on that? Is VC better or worse for certain kinds of companies? The answer is absolutely it's better or worse. It's better or worse for certain kinds of companies. And the companies that do need it are the ones that, but for all intents and purposes, they can't build anything without having someone take a risk on giving them money. And the aspects of reducing technical risk and building a product and creating a market is something that other equity sources don't want to take the risk on. So, getting into a bank loan, or getting a research grant for a company that's needs to, build a sales team. Like, you can't necessarily get those dollars, but where you can avoid venture are in companies that are kind of in proven business models. To be kind of blunt, like, a laundry business does not need venture capital. You need a good business plan to go to a bank with and say, hey, I need a loan at a reasonable rate because I know and study the industry that if I buy this, I can sell this. And so certain aspects of venture capital are not necessary for all startups. And particularly in the university space, certain startups are not relevant for venture capital. Certain startups don't necessarily have the story of needing to absorb tens of millions of dollars to then, create hundreds of millions of dollars of value, because they just don't need that much capital to do what they're doing. And part of this goes into something we'll talk about later, which is picking the right venture firm for you. There's large venture firms out there that are managing $2 billion and they're looking to invest 100 or $200 million into each company, along with other investors that want to invest in that same company, so that the company might raise $500 million. And if you have a business that's focused on, selling a really interesting technology for, analyzing chemicals for fragrance companies, like a very narrow but high technology thing, that's not necessarily where a big venture firm is going to play. It might be an area where smaller venture firms are interested. And so those are just some things to think about. One of the questions is about PitchBook and some information they were required to or asked to provide. I would avoid giving your information if you can. Revenue, EBITDA, and net income details. I've never created my own account in PitchBook, so it's hard for me to know if it's a required field. It does actually give me some information as to how they get some of the information they have. Every so often, there are startups in there that have like a revenue number, and I have no idea where it comes from. You may have just given me the information. But I think most investors would take it with a grain of salt and don't really use it for those purposes. And so as a pre-seed company, like no doubt, you don't need to bother with that. So I would avoid it. Well, so now that I've hopefully given you a quick rundown of what goes on in the venture side, I thought I would go into some topics related to your own VC fundraising journey, should you ever take on that extreme, exciting journey. And I wanted to start with a few terms because I just don't know the background of the audience. Some of these I've already mentioned today, but in short, when you're looking to raise venture capital, you are selling a portion of your company. And there's a whole topic, a whole seminar we give on term sheets and things like that. These term sheets are the terms by which the investor wants to invest in your company, is offering to invest in your company. And these are some of the key terms that are worth thinking about. There's a great book called Venture Deals by Brad Feld, which goes through a lot of the dynamics of term sheets and venture capital and things to be aware of and the impact of certain terms that are investor friendly, not founder friendly. But a few of the ones that you should be thinking about here are your pre-money valuation. So if I, as an investor, want to invest in your company, I am going to say I want to invest, let's say, $5 million at a pre-money valuation of $10 million. And that $10 million is just simply the share price that we're offering times the number of shares in your company. The number of shares before you've taken on any capital are completely arbitrary. It could be 1 million shares, it could be 1 billion shares. It just matters. It just affects the share price. The post-money valuation is the new valuation of your company after the money comes in. And it's basically the pre-money plus the amount raised, plus or minus, a few small things not worth talking about. And that's the share price times the total number of shares you've now had in the company after you gave new shares to the new investors. And now the fully diluted ownership of the fully diluted aspects of the company are the total shares outstanding, which is important because as founders or as entrepreneurs, your shares divided by the fully diluted shares of the company is your percentage ownership. And that is what changes over time as you raise capital. So you will get diluted over time as you raise more capital, and it's a quick calculation. Now, you own, as entrepreneurs and founders or employees at startups, you own common stock or options to buy common stock, and these are not investor stocks. As a private startup, most 99% of all venture investors are going to be buying preferred stock. So we buy preferred stock because we can, and we have certain terms of that preferred stock which are beneficial to us mostly in downside scenarios. So we're not going to go too deeply into it here, but the quick way to think of the difference between preferred stock and common stock is preferred stock in downside scenarios gets their money back first. And so in a scenario where, let's say, you as a founder or an employee own 10% of the company, you've raised $10 million and you get sold for $1 billion. Preferred stock in that situation just almost doesn't matter. Everyone gets their percentage of the company. But let's say you've raised $10 million and you sell the company for $10 million. To the first order, the investors get that full $10 million back, and there's zero left for everyone else. And so making sure you're aware of these terms and how they stack, and making sure your preference stack, which is the total amount of capital basically that your investors have invested, doesn't get bigger than your ultimate exit size is really important. And so we've seen companies, raise hundreds of millions of dollars for ultimately, as the market changes, the exit, it might be only worth $100 million, which is not a good outcome for anyone, but it's definitely not a good outcome for the people that have put their blood, sweat, and tears into the company over the years. So I hope some of this is useful information. I apologize if many of you are ahead of the game and understanding this. But as you think about, building your first venture round, the important things to think through is how much money are you going to ask for? How much capital do you want to raise? There is definitively, as you get to be an older company, a really solid financial plan you should build based on your expectations of revenue growth and hiring and CapEx and OpEx. But it's a little bit arbitrary in the seed, pre-seed stage. Really you want to think of the capital you need as some function of time, which for most startups should always be what gets me 18 months of runway. Like keep that number in your head, 18 months. You don't want to have to raise every 2 months. How much OpEx you need to pay the bills, pay salaries, and pay for travel, as well as CapEx. A lot of you are in deep tech companies where you might have to buy equipment or pay for tape outs. And so that's, the arbitrary function that you need to be thinking about of the capital you need to raise. And then that's decided roughly by you. Now you can have plenty of markets where you can have investors knocking on your door or wanting to give you, 10, 20, $30 million more than you want, and that's a good place to be in. But that's not always a good thing to take, because also the other part of the formula is the valuation of that round. And the valuation is something that's generally provided as an offer from the investors that want to invest, the lead investor that wants to invest in your company. And that's another, especially at the seed stage, a relatively qualitative assessment that fits into the pattern matching of investors and comparables and analysis of other companies like yours. But it is some function of your progress, revenue if you have it, your product, how risky it is, what's built, what still has to be technically de-risked, the market you're in. AI is a much more compelling market right now than certain areas, and the experience of the team, primarily the CEO. And so there are blank check entrepreneurs out there who will get a much higher valuation for their sheer record of success or experience. And so those two terms, the valuation and the capital raise, come together to build this really complicated formula of dilution, which is the capital you've raised divided by the post-money valuation. And your new ownership of the company, if you used to own 100% of the company as a single founder, let's say, your new ownership is then diluted by that amount. So if you raise $5 million on a 10 million pre, your post-money valuation is 15 million. Your dilution is 33%, 5 divided by 15, and your new ownership becomes 100% times 1 minus 33%. So you now have sold off 33% of your company. You own 66%, and that is what you've given up. But you've also brought on, hopefully, a great partner as an investor that will help you hire, evaluate product market fit, work through, breaking down walls to help you with technical problems or product or customer traction. Those are the things you should be thinking about as from the investors you work with. Are they going to deliver on the value that they need to make up for what you've sold in the company? So on your journey to raise venture capital, there's a couple paths, and very early on out of a university, you should be thinking about that question someone asked earlier. Do I need venture dollars? Should I take venture dollars? I'm of the camp at some point you will, depending on what kind of startup you are, but early on, you don't have to. And so as a startup out of the university, you have interesting paths for non-dilutive funding that many other startups in the world don't have. So you've typically been involved in major research grants at the university. You've written proposals to DoD, to NSF, to NIH, and you should leverage that as a startup because it is an interesting non-dilutive path for your company because they, invest in you without asking for a portion of your company. And so groups like the NSF Corps, SBI or STTRs are very active in providing resources to small businesses so they can address some of the product market fit challenges and technical de-risking. But in just the 10 years I've been at OUP, we've seen a real thriving ecosystem of resources from universities. And so groups at universities have access to um, POC funds, pitch competitions that can generate dollars. University resources like the Tech Transfer Office might have connections to legal firms that can offer pro bono services, which is effectively non-dilutive support. And these are all things that you should be networking to your MIT TLO about just so that you can see what's available to you. They're hubs of information that most researchers at universities don't realize. They've seen dozens, MIT sees, dozens of startups a year, and hundreds of startups have gone through their doors. And so they can really help you on that non-dilutive path, and help you with connections to figure out the non-dilutive path if you'd like. But the equity side is something that, is a journey. It goes through many different stages that are a little more clear cut. So as soon as you've launched the company out of the university, you've gotten your license, you're ready to hit the ground running. You do want to start to think about groups that can help you in exchange for equity, and you should be really judicious about what you're giving up. So accelerators and incubators are places that generally will say, hey, for $250,000, which hopefully helps you, hire first employee, we want some percentage of your company, but we're also going to put you through the ringer on product market fit and customer introductions and make sure you really, know how to hone a pitch deck. And they can be really useful and just give you momentum. And as you go through that, when you're ready to launch the company, either from a team perspective or a product perspective, you can generally start to talk to angel investors and friends and family about investing in your company. And these are typically rounds that are done with convertible notes, less than $1 or $2 million. We've seen all shapes and sizes. And then once you kind of get through that, you're on this venture capital and strategic capital path where scaling can mean multiple things. It's not just about scaling revenue. It can be scaling production of your benchtop system to a pilot plant. It can be about getting your first chips taped out. Hopefully, if you're software, it's about getting your first alpha customers so you can, have referrals on pilots. This is the journey you should be thinking about. And with a little more detail on these, that I don't know if I'm going to spend too much time in because I'm happy to share these slides and the video is going to be open. There's just a lot of approaches to getting non-dilutive dollars. And I do want to say, particularly in the kind of SBIR, STTR route, because that's becoming a big area for the government to figure out how do we promote startups and pull away from the primes in the DoD world. One thing to think about is, ultimately, when you take money from non-dilutive sources, usually it's on some statement of work, particularly in SBIRs and STTRs, where they want you to build something that's relevant to the government. And what you want to make sure as a startup is that you're building something that's relevant to the commercial world. And those two worlds don't always overlap. And they can be very addictive for university researchers because you're so good at getting grants. Like grants can be really easy to come by. When I speak to entrepreneurs who haven't come from the grant world or connected to government research organizations, like how do I get an SBIR, STTR? Like they don't necessarily know. And so as you think about that journey of non-dilutive, it's a view that investors will look at and say, wow, they were really scrappy. They were able to put together 3 or 4 million of non-dilutive income towards building a next generation soldier suit for CBRNE, for ChemBio. But what does that have to do with selling materials to DuPont? And so, you want to know when to gracefully off ramp the SBIR, STTR work. And that's generally when you have a product that you can focus on selling commercially, and you have a sales team that has to sell. So the other things I'll mention on the equity side is there's used to be only a few accelerators that the venture world focused on. Everyone's heard of, Y Combinator and Techstars, but there's starting to be a few really interesting, let's call it sector specific or deep tech specific accelerators and incubators out there. So, locally in Boston, the Engine Blueprint program is fantastic. Harvard has the iLab. There's a big effort called Activate, which is really focused on climate. And what these accelerators do is they've kind of catered their plan to the world of deep tech, knowing that you can't just build a pilot in 6 months like a piece of software and sell it to Merck or Capital One for 50,000 a year. And so it's less about getting exposure to and developing products, and more about really evaluating what customers need and integrating your products in the market and not selling. And so we've had some university spinouts go through Y Combinator and others because they're starting to also build their deep tech thrusts. And they generally say it was a great program. I got exposure to so many investors. And so if you can, you really do your research and figure out where your sector overlaps with the accelerators that are useful, because they can be really helpful if you find the right one. I have a few of them listed here. And I'll just briefly mention on the angels and family and friends investment rounds. It's always hard to negotiate with sometimes people that aren't necessarily in the business of investing on what the right terms are of a venture investment, of an angel investment. And so the industry is consolidated around this language called a safe note or a convertible note round. And what these are is, from a group of angels or family that want to give you $500,000 or $1 million. They don't know how to value your company. Your company's not worth really that much in these early days. It's not worth $20 million. If, it might be worth $2 million, but you don't want to necessarily sell 50% of your company at that point. But your friends and your angels want to support you. They want to be part of that success. For them, for angels specifically, it's mostly about accessing a company to invest in early before the big investors come in that would never let them in the round. And so their motivation is to help you as a family member or as an angel investor. It's to access that next round. And so a convertible note, without going into too many of the details here, kind of kicks the can on the valuation. So instead of setting the valuation at 2, you'd say, this 1 million I'm investing in your company today is such that it will convert into the price of the next round with some discount that's usually in the range of a 20% discount. There's also some things called a cap, which is meant to say, okay, if things go crazy and you're worth, $20 million at your seed round or $30 million, I probably would not have invested. So let's put a cap on it that's, roughly $10 million. Really encourage you to read Venture Deals. It goes through all of this. And then on the strategic venture side, this is something university spinouts can really leverage. You all have, many connections to corporations given what you do at the university. And most corporations across life science and tech have venture teams. They have corporate venture firms that are meant to scout technologies and startups that can be helpful for the company. And there's just already a friendly relationship you might have with many of those corporations that could be leveraged into, good networking within the company for venture investment and commercial investment. And they can be really helpful in accelerating you through that commercial world. It's something we look at in the really hard tech companies that come out of universities. It's really interesting to see if, you're a photonics company and Google's investing in your Series A round because they see your transceiver as really relevant to their data centers. It's a signal that wasn't always received well in classic software companies. So, but in the deep tech world, strategic VCs have really, come in strongly into this space, but they've also been really helpful for commercial signals to other investors. and they can write very big checks. But now let's just say you're going after a classic institutional venture investor like myself, um, or an institutional venture firm like OUP. What you want to think about and know is the structure of deal flow that we work with, because it's pretty simple. Most venture firms have a hierarchy of deal flow, and the managing partners, the kind of most senior people at the firm, have all gone through this usually. And the junior team is composed of associates and principals, and they're the ones that are responsible and kind of have the duty to like, hey, go find companies, go network with entrepreneurs, and have a call with them. And if it's interesting, we'll kick off our process. And that's typically a lot of venture firms work in pods of 2 or 3 that involve a partner and a junior team member, like an associate or a principal. And so I mention this because sometimes people with experience of all sorts, repeat entrepreneurs, university professors, people with egos that haven't really kind of balanced to this world of venture, they want to speak to the decision maker. They're used to knowing the decision maker right away, and getting the door open with them. But associates are your advocates within the firm. They're doing the diligence. They're doing the work. They're kind of stirring up the dirt to understand what's happening, and they're coming up with the investment memo. And so don't undervalue the associate's role in your process. And they're the ones that are trying to make their career on their next deal. And so they're the ones that are also going to be the most likely to respond to you. And so managing partners have to juggle a lot of different things. One of them is generally not deal flow. And so they're not used to responding to those emails. They're probably not even good about responding to those emails. But as you go through that process of working with an associate, then working with a team, the pod doing diligence, the team then kind of elevates the deal if they are interested in investing, want to recommend investing for an investment decision. So this is typically what's brought to most venture firms call it the investment committee, where the startup will present to a team of 3 or 4 investment committee members. Well, in some firms they literally vote. Some firms it's a discussion and long negotiation. In some firms it's kind of like hey, as long as you want to do the deal, I'm okay with it. So every firm has their own decision process, and as you work through the process, make sure you get clarity on it. Ask the venture firms, what is your decision process? What is the next step? Know that most associates are your gateway, but they're not decision makers. And so if you find yourself talking to a junior person, 5 times over a month period, and you haven't yet spoken to a partner, you should feel justified in saying like, hey, should we elevate this to a bigger team so we can move forward with a decision? A lot of the junior teams, I experienced this, I still do, indecision, right? Figuring out how much more do I need to learn before I can really make the case to my full team. It's okay for you to push on that a little bit. And the numbers don't play in your favor. So the reality is venture firms receive information and deal flow from a variety of sources, and oftentimes it's a really game of small numbers, where we might look at it. I might look at 1,000 pitch decks a year, and only 28% of those do I really say, okay, this is interesting enough to meet management. This all comes from data from our pipeline, and meet the management of the startup. So I'll have a first call with a startup, and at some point, if it's interesting, I'll say, okay, I want to get this to my pod, my team, get another partner involved in it, and only 10% of those end up getting to, and 10% of the first calls get to the second call. And then after that kind of second call, where you're talking to more of the investment team members, not the investment committee, do we kick into gear of like due diligence, where we're saying, okay, we want to know everything about the company. We want to fly out and meet you. We want to speak to your grandmother who packed your lunch for 2 years. And we do our own digging of people that have worked with you before. We'll go on LinkedIn and see who's in your network that we know and say, hey, what's it like to work with Lisa? And we're also talking to potential buyers of your product to do commercial diligence on what you're doing. And if you get through that due diligence process, you know, then you're kind of at the investment committee level where the due diligence team has said, hey, we want you to pitch to our investment committee. We're excited about investing in you, but hey, there's one more gate. There's just one more. And if the investment committee is gung ho about it, and you're speaking with a lead investor, they'll offer you a term sheet. And the term sheet is what I touched on briefly before. It's the terms that by which we would invest. And at that point, it's in your court. It's in your court to negotiate. Hopefully it's in your court to accept. It's in your court to negotiate and um, and talk to advisors. Understand who you're working with. Due diligence on the VC yourself. Get to know who they are. Um, Talk to other portfolio companies of theirs that they've invested in to get a sense of whether you want to, get married to this investor. We're doing this on you, and we always love it when our startups that we're excited about say, hey, can I talk to 2 or 3 portfolio companies that have worked with you? And then when you accept that term sheet, um, you're then going through a legal process of closing. And generally, most startups that get to term sheet do get to closing. There's a little bit of leakage here, but sometimes things pop up. It's just, time doesn't always help. The term sheet is a non-binding commitment. So the only thing that you're really signing and agreeing to in a term sheet is that you won't go out and market yourself to a bunch of other lead investors to, use our term sheet as a stalking horse for a better deal. And so you can do that before you sign the term sheet. Like that's playing the game of venture. You've probably been having several fundraising conversations at once. And when you receive a term sheet, you can tell another investor that's been interested, hey, I've got another term sheet. You guys have to move quickly if you want to lead this round. And they will. Sometimes they will if they're really excited. But that closing process is where lawyers come in. It's all pretty cookie cutter. There's template documents out there from the NVCA that I don't suggest you go spend your time reading. But when you do take on your first investment, you should read all of them and have your lawyer make sure you understand them. So I'm not going to go through everything on this slide, but there's 2 slides here. One is this is a life science focused slide, and there's a one after this. It's a tech focused slide. But it's about knowing your investors that you're going to find. So it really is like surprising to me when I get inbound emails, which our firm is, I'm totally okay receiving inbound emails from anyone building a university spinout. But sometimes I'll receive emails from a laundry business, and I just don't even have. I'm just like so shocked that they haven't done their work to find out who we are. And so you should do your work to find out who the investors are that are in your category. And these slides are a little dated in the who. We're going to be updating them soon. But different venture firms operate at different stages. Different venture firms operate in different sectors, obviously. And knowing the firms that are right for you is really important. So in the life science side, there's investors that only do company formation, and then they invest over the life cycle of the company. There's venture firms that only do, clinical, early stage IND ready investments or later. And there's investors that do only crossovers. In this pretty hypey world of venture capital right now, investors are still, there's always exceptions. You'll find investors going across all different stages, but it's really important that you focus in on the way the investors that are in your space. In the tech side, it's similar. There was a time where the corporate venture firms were mostly investing in product market fit type companies that were getting ready to sell. They've crept earlier and earlier into deep tech. All of the biggest tech VC firms in the country invest in university spinouts. They don't do it as a rule, but those really big funds like NEA and Sequoia will invest across the entire life cycle. So tech is a little more blurred. So there in the tech world, it's really important for you to go find the investors that have been investing in your general category. And that's another place where PitchBook comes in to be really helpful. So you know what you're building as a company. Hopefully you've done research to find comparable startups in the space and go see who the investors are that have been active in those categories. And hopefully you find many investors that haven't really placed their bet in your specific field, right? There's investors who will put multiple bets into competing companies. We've done it every so often. Generally, it's not as much of a concern as most entrepreneurs think it is. Um, but there's also some aspects of, how many, concrete sequestration companies is one firm going to invest in. And so you want to make sure you spend your time appropriately and talk to venture firms that are right for you. And I'm not going to, this is me. So you also want to dig into the person at the firm. So it's best if you find, as you're doing cold reach outs, find the person in your firm that overlaps with what you're doing. So I'm not your life science investor. So that's something that's easily done nowadays with LinkedIn and the biographies on websites for venture firms. And so when you email the right person, or since some people would say cold emailing doesn't work, when you speak to people who might be helpful for networking, ask them if they can connect you to XYZ person at OUP, because it's very good to be specific and do your homework on them and increase your odds of getting that connection that you want. It's something that, to rise above the noise of an introduction, you really want to make sure you're the right person. You're working with the right person. And the other thing to think about is I was talking to you before about the process of getting to a lead term sheet. But hopefully in the process of signing that term sheet with a lead investor, you've also had several other conversations, because VCs work together. We know startups, specifically university spinouts, require a lot of capital, and we don't want to be the only one on the hook for all future fundraises. And so while some VCs are saying, I'm the lead investor, I only lead, they know that they have to work within a syndicate. And it's both up to you and up to the VC to build that syndicate. We like to think the entrepreneur should control that decision, and you should. And the way you do is by, in your fundraising process, you have many types of investors that are in the mix. You have investors that lead only. You have investors that like to lead, but they're okay syndicating. And you have investors that never lead. And so you've got to put this jigsaw puzzle together, let's say in your $10 million fundraise, because the lead investor might want to invest 6, and you have to fill out the rest of the 4. They want you to fill out the rest of the 4. And you want to have a process such that those syndicate investors are basically ready once you've found your lead investor. That's generally the way it goes. Things move pretty quickly after a term sheet comes together. There's all sorts of syndication methods. There's all sorts of like syndicate VCs. The most annoying thing I think entrepreneurs have to hear from VCs is, hey, I think your company is really interesting. Let me know when you have a lead. And in that sense, they haven't really given you the conviction that they want to invest in your company. And they've put more work on you to remember to go back to them. And they've also kind of said, like, I'm only interested in this if somebody else is. And it's a weird little game and venture where the pendulum swings back and forth. In some time frames, like AI for right now, you have all the power, right? Everyone is looking to invest in that category. The lead will quickly come together, and they don't want to have to start another diligence process with a set of syndicate investors, and so they want things to be really, entrepreneurs have all the selling power. But in certain sectors over the years, let's take semiconductors 10 years ago, you could have a really strong lead investor, but it was really hard to fill out that syndicate. And so you just had to be patient and respectful, and really work with your VCs as partners, is the best thing I can suggest. And lastly, like, I think this is a mantra that one of my old colleagues, Lou Berneman, used to say is, when you're raising venture capital, ask for advice, because, if you're asking for money, you're going to get advice. Venture investors love to do their pattern matching and say all the different businesses they've spoken to that are just like yours, and here's how they failed and succeeded. And if you really kind of talk to them and just look for advice, then maybe you might get some money. So it's just that mindset. Obviously, if you're raising, you're raising. But if you create a conversation that's back and forth, not a pure pitch, you're open to feedback, you're really kind of looking to learn from what they know, and have it be a two-way conversation, then you really can build this relationship that hopefully will lead to investment. And a few other things I like to just kind of mention to the university spin-out researchers I speak with is, we take for granted, we know your technology is great. We are going to have a very hard time, even as deep tech investors, figuring out whether your approach to quantum computing is different than some other stellar professor's approach. But what we can have an eye on are the teams that really know how to build quickly, how to focus on product market fit, and how to hire great people. And so I often tell faculty and graduate students, like, just pause the technical development for a few months. Because even if you pause it, your mind's still going to be spinning on it. So I know you'll never really fully stop, but give yourself the opportunity to really evaluate the markets you're going into, learn about the history of a market, get your PhD in the market that you're going into, understand the startups that have succeeded and failed in the category, because that's the type of learning that it's not rocket science. You all have been pushing the limits of technology for years, and like you want to find the people and the knowledge that will help you push the limits of a product, and that requires really learning the history of it and talking to people that have been at it for a while. But lastly, like, talk to the tech transfer office. I really think you'd find, if you haven't spent time with the tech transfer office at your institution, they're tooled up. They're arming up for this world of entrepreneurship out of universities. MIT's been at the forefront of it forever. But there are a lot of resources they are bringing to bear for the spin-outs out of their community, because it's becoming a great tool for the university. It helps with recruiting. It helps bring in big industry partnerships, and it helps just, improve the overall excitement of the university. And so we've really found across the country lots of new resources available to the startups when they just go ask the tech transfer office for help. So I think we can pause here. I was hoping to leave a couple minutes for questions. One of the questions that popped in was, who are the most reputable VCs in medtech? Hard for me to say. I'm not active in that space. There's a few that I've heard about, USVP being the most active one, and Longitude. And this is where I think you'd find, if you went into our YouTube page, we've had a webinar that we gave from our life science colleagues on medtech. And if you don't see it there, feel free to email me, because we have a separate presentation of who's been active in that space. It's just not my vertical, so I don't know it that well. I'm going to pause for a second and see if anyone wants to take their mic off and ask some questions. There's other things I can talk about, but I'll leave a second for anyone to jump in. I think there's a new question that came in on this chat. So one of the questions that came in is, when we're investing in spinouts, how do you consider the patent option versus licensing? And do you wait for the license? Do you invest in the option with conditions around the license? I think this is a fantastic question. So, and I think the view we have is, because we work so closely with the tech transfer office as an investor, we're not a part of the tech transfer office, just kind of how we built our brand. And the tech transfer office brought us in today to give this talk. We know the importance of an option. We know it's not a guarantee, but it is really valuable to have that option. We generally will not require it as a condition to investment. Some firms do. We have seen enough of the university spin-out landscape that as long as the startup's in good standing with the university, generally signified by they're willing to give an option to that startup, that typically can lead to a license. And where we've seen a lot of risky activity in the past couple of years are in startups that are doing neither before they spin out and raise capital. And while for all it's pretty obvious, like, licensing to large corporations is the main alternative for a tech transfer office to a startup. that versus a startup, and those are happening less frequently than ever, particularly in tech. You know, if you were to raise capital before you get your license, the IP has just become that much more important, and it's become that much more valuable. You know, you've put yourself in a position where you're at risk, and entrepreneurs often go back to the university and say, "You don't get it. I just raised this capital. I told them I'd be able to get a license or an option, and you have to do this." Well, you've just increased the value of your company because you've taken on capital. So it is more valuable to the university, and so you need that license. Like, just from a negotiations 101 perspective, you're not in a good position if you're desperately needing something from the university. And so we always do recommend to go have those conversations with the tech transfer office and start the option process before you raise capital. So I'll keep going then, as long as there's no other questions. I'm going to skip this pitch deck because I wanted to make time to make sure we talk about founders equity. Um, Founders equity is a really interesting topic at universities because oftentimes spinouts are composed of a few grad students and a professor, just a professor and a co-founder from outside the university, two graduate students who were best friends, but one of them was really entrepreneurial, the other was very much a CTO. And it makes for a really different conversation than what you usually have in your university lab. I'm going to pause because there's a question. Okay, I'll skip that question. So when you think about the equity that you're going to be splitting amongst founders, this is a really big decision. And if there's any takeaway you should have today, it is that it shouldn't necessarily be equal. So what you want to do is incentivize how you distribute equity based on rewarding for past contributions. The professor who's been building this base of research for 10, 20 years, and incentivizing the future performance of that person. The graduate student or professor who's going to leave the university for some period of time and go work full time at this startup, full throttle, not 40 hours a week, 60 or 80 hours a week, like all of us do as we kind of push ourselves in our careers, because it is their single focus. And so those are the two buckets you should really be evaluating the equity distributions amongst your companies. And we created this kind of quick set of slides because it's a big topic at universities. You've got really interesting dynamics. I'll just bluntly call it out. A professor who is an advisor to his or her graduate student who wants to start a company, but he's wrapping up his PhD. And you can imagine a dynamic there where they're holding that graduation over the heads of the students. Or it's just a weird conversation, right? You've got a professor and a graduate student who got along really well, but you might have to tell your boss, "Hey, I don't think you deserve as much. I'm going to be the CEO of the company. You've been my advisor as a professor for the past 5 years, but I'm now going to be your boss." And so how do you have those conversations, and what's typical? We try to create this set of slides to lay out some of the fundamentals about it. And generally when you're starting a company, the first thing to think about is you're going to hire more people. So there's an option pool that's roughly 20% of your company that's going to be used to hire your first engineers, maybe some external, strategy, business-minded people, product people. But the remainder of the pie, the remainder of the 80%, is typically weighted heavily towards the lead founder, this CEO-like person. And they're going to get a larger portion of the company. It's this person's working full throttle, learning about many new areas of business, hiring, recruiting. They're the face of the company, and they can receive outsized rewards for doing that. And generally, this is the person that is both entrepreneurial and technical in spinouts. They're the professor or graduate student who's taking on that role because they can do it and they want to do it. And then in the other group, there's co-founders and key employees who are splitting the rest of that roughly 40%. There's big error bars here. But I think that's a general concept to have. And it's typically not equal in that the CEO in that 30 to 60% range has a larger portion of the company than maybe the two other co-founders that are squeezing into the rest. And that's okay. Because the reason of doing it poorly is that you can really end up with an equity allocation that no one wants to invest in. When we invest in your company, we're looking at your cap table. The cap table is the ledger of who owns what in your startup. And if we think someone is on the cap table who's not contributing to the future of the company, it's really messy to fix that. And it's almost, think of it as investors are looking for a reason to say no. You want them to say, you're looking for ways to get them to say yes. We're looking for reasons to say no. It's really hard to restructure a company's ownership. But other reasons are, when there's a former or a founder who's not doing as much as others in the company, you're looking at that equity ownership that they have compared to your option pool, which only goes down to zero. And you're saying, oh man, my option pool is down to zero. I need to increase the option pool to hire new employees. This is how you incentivize new employees. I wish I could just take it from, my graduate student colleague who thought he was going to join the company, but decided to leave after 2 years. And so anyone that's sitting on the cap table, investors, co-founders, employees you gave a big grant to, who's not contributing, ends up just creating friction at the company. So you really want to do it correctly. And how to do it correctly, we've now, because we've heard about this problem so often, we try to put data behind it. So I'm not going to have time to go through all of this, but what we did as an investor in university spinouts is we said, hey, we probably have some of the best data on what does a venture backable university spinout cap table look like at founding. So we surveyed around 100 of our portfolio companies. We went to the founders equity and looked and mapped out and logged who owned what and tried to put them in different buckets. And it's a little bit messy. Some companies had a founding CEO, some didn't. Some had 3 founders, some had 1 founder. You could imagine it being really imperfect. But the main thing to see here is all the way on the left, founding CEOs generally have skewed higher in ownership than every other category, except for maybe the founding inventor. And so usually there's a founding CEO and a founding inventor. In most every tech startup I've ever been a part of investing, one of the inventors is full-time, full throttle at the company, almost like the CEO, if not the CEO. But as you get to other inventors, the pool gets split a little bit. Also, all the way on the right, there is an aspect of university spinouts where the university owns a portion of your company via the license in that startup. And that's because oftentimes in the history of university licensing, they could license to large corporations and get large upfront payments because the corporations had the capital to do so. University spinouts don't have the capital to do so. Universities don't necessarily, we've coached them on this, many of them know, they don't want to take away from your equity dollars, have you pay a $100,000, $500,000 upfront fee, because that would drain the company. So they exchange that for equity. And so we've seen a lot of data on this. And in the next slide, we kind of sum up some of that data. And what you can see here is the founding CEOs are generally in this kind of 30 to plus or minus 20% ownership space. They're well compensated. They are oftentimes at the earliest days very technical, as I mentioned. But as you get to the remainder of the pool of kind of types of people on your cap table of your founders, if there's 2 founders, you're each getting roughly 20%, and then the CEO is getting a 30%. There's 3 founders. It's these are just kind of guidelines. The key thing to think about here that many of you may deal with is what happens when you have a part-time founder, a part-time faculty founder who's not leaving the university, or a graduate student who is taking another job because it doesn't want to take the risk of the company. What's the right equity allocation for that? And we've generally seen the 5% category, like the 5% range is about right. This is all pre-options, pre-venture dollars. Now, certain faculty that have tons of industry connections, they've started companies before, they are going to really help with networking to VCs. They deserve more. But this 5% is just meant to be a guideline, and it's not a rule. So some cap tables we've seen don't reflect this, and those are the ones that just get harder to invest in because your investors will look at this. And lastly, I'll just mention something you should do as founders is, surround yourself with advisors who can be helpful on all the things that you're not good at. Go find former CEOs of corporations that have been in your space or startup founders that have succeeded in your space and bring them on as advisors. You don't want to pay them a salary. You reward them with equity. And that's in like the 1% range for these early days of the company.